Hey everyone, welcome to another market review. Sorry for my voice, I got a bit of a cold. Now let's look at what happened and what's next. We have another week of continuous claims, which also was lower, and uh, this points towards the economic data this week being uh, not being as bearish as people think. So we have F jolts tomorrow. And I think this will be the bottom in jolts, if not this month, then the month following this one. And the impact from immigration is going to make it impossible for job openings to continue going down. This is my thesis basically. And then we have on Friday NFP and unemployment. Where's Friday? Friday here. Non-farm payrolls and unemployment rate. NFP is still going to be weak, but I expect positive revisions for August. And this month, I think we get basically expectation like 40, 50K, something like this, which should be fine. And unemployment either peaking, getting 4.3, and this will be the peak in unemployment, or actually getting a bit lower unemployment. We shall see how that plays out. If we look at breadth, Uh, I said last week that even though the market was at all-time high, even a small drop percentage-wise from the market would get us in oversold for breadth very quickly. I didn't expect it to be this small, but it is what it is. And like I said, like we went low very quickly. And I still think this is the case, but most likely we can go as low as the 44 EMA. For SPY, this means basically 650. And I would expect if we do so, maybe the government shutdown thing, which basically on Wednesday, uh, if the Democrats don't agree to what Trump wants, they're going into shutdown again after 7 years. Maybe that brings us down in the market briefly. I would expect that we go down to like 650, but on a bullish divergence on breadth, and that will be like a bottom as well. Like everything I'm seeing is saying the market does not want to go down at all. Let's switch to 30 minutes, SPY, put the pivot ribbon on, and switch to daily like this. So basically, I posted this on Friday. I thought maybe we would do a retest of the 21 EMA where we bounced from. Thesis last week was we will, if we get the soft scenario, which is actually bullish, we would get either a drop to the 13, like basically this and bounce, or here and bounce, or go to the 34 and bounce. I still think this is the case now, that this might not be an actual full recovery, even though futures are green and we are basically at this level. So we are here. So market went even higher in the pre-market session. Basically, we are here. So this doesn't mean that we have recovered fully quite yet, and there's still the risk of going to the 44 EMA. Actually, this is my main uh, case for this week. So basically, due to the government shutdown kind of thing, maybe we actually go retest the high. But due to the government shutdown thing, I think we may get a drop to the 44 EMA and 650. But then we bounce and case one, like a retest of the 21 EMA. Case 2 go as low as the 34, and then we bounce because we, even though the drop percentage wise is very small, we get into very oversold very quickly due to the way breadth is. And this could happen very quickly, like Wednesday plus Thursday. Is like I said, it's not a big percentage drop, so it can happen very quickly. Even if we do this, like it's only 2%, you can easily do this over 2 days. But when jobs data comes in Friday and it's not as bearish as people think, I think the market will have a positive reaction, especially if it's like 4.2 unemployment and I don't know, maybe a 60K NFP plus upward revision from last month. The market would absolutely love this, and we start another leg up from that point. Another reason why I think this is the case is what happened with market flow with flows this week. I posted that SPX from Thursday. This was the number day two ever for SPX in premiums, so quite significant. And everything we've seen is just a rollout of existing positions. So those 5Ks and 6K positions that are expiring in the next month or so have been rolled into much further out. Some even to like December 2020, 2030, sorry. So whenever we see this type of activity in the market, and this is the most notable activity you will see in flows actually, not those far out of the money or something like this, is basically rolls. Money that is already in the market, staying in the market and showing confidence in what is going to happen next from a bullish perspective. So whenever we see this type of rolls, it's generally a good thing from a bullish perspective. It means participants with big money are showing confidence in the market and are staying long in these long-term positions. This doesn't mean that we cannot have like 10% drops or normal corrections, but confidence like 2030 is very bullish. Like if someone moves this kind of money into 2030. So this is kind of the take for this week. We didn't really have anything that interesting happen, and like by the way, this can be skipped as well. So maybe no, I'll leave it like this. So this is the main case. Afterwards, we go higher. Maybe we even hit 7K this year. We shall see. Although this resistance area is going to prove tough to break. We'll see 670 for sure, basically, in this run up. And if we somehow get a breakout above this level, this trend line, things can really go crazy because this is not only a breakout of this one, like what I drew here, it's a major breakout from lots of trend lines from historic trend lines. And although I expect this to be a fake out and eventually we will correct in a significant way, and the bull market will end, like the AI bubble will pop, uh, this like deviation above the trend line before we return, it can be very profitable and significant. Let me go to SPX. We do log chart. Don't need a ribbon. And we do like 3 month. But now I have to find that specific one. Hide all of this. I don't remember what it was. But we have the trend line from the 2020 1930 crash basically. I'll draw it again. So something like this. And like I said, we can have deviations, like for example, click the way to draw it, let's say, or from here. Let's say we don't have this, and we just do this as a trend line. Big deviation here in 2000s, and we went below it. Let's say this is the midpoint or something. And let's do it like this. Let's make it a channel. And we see, say like this. So we still have quite a bit of room. This is like 870 if we were to get to it because it's a logarithmic chart. So let's say this is the maximum deviation. I'll bring it down a bit. Something like this. So there's still room in this bull market. Next year it would be like No, this is next quarter. So let's do 6-month chart. 8400, something like this. We'll see if it plays out like it. I'm not saying this is going to happen, but there is still room to go higher. Even if we were to contradict this long-term trend line from the bull market on the logarithmic from the 1930 crash on the logarithmic chart, like deviations happen all the time, and it wouldn't be completely out of the question to go like to 8K and still be considered deviation. And when we come back down, it would drop significantly, like a lot, 80%. Anyway, that's it for this week. Have a good one. Bye bye.